AUSTRAC starter kits legitimise open source customer due diligence for small reporting entities, marking a possible solution for developing countries across the Asia-Pacific region. So when AUSTRAC published its program starter kits for newly regulated Tranche 2 entities in January, most compliance professionals expected to see the usual playbook: subscribe to a commercial screening platform, plug it into your onboarding process, write a check, move forward. The kits took a different path. So for small, low complexity businesses with 15 or fewer staff, AUSTRAC has said that reporting entities can basically essentially use internet search engines to screen customers against sanctions lists, check for PEP status, and look for adverse media. So the guidance gets really specific. The firms are being told to check customer names against publicly available sanctions lists on government websites. They can run queries pairing a customer's name with terms like sanctions, fraud, money laundering, or politically exposed person. And they want them to keep a record of what they find on only the first 3 pages of a search engine. This is really prescriptive. And this level of simplicity and prescription builds on AUSTRAC's existing PEP guidance, which already notes that firms can identify PEPs by checking a customer's background on the internet, including sanctions, lists, and social media. So the starter kits are turning that suggestion into a structured, repeatable process. Now the logic here is pretty straightforward. Australia's AML-CTF framework is outcomes based. So if the point of screening is to identify sanctioned individuals, PEPs, and adverse media, then the tool matters less than whether you actually found these results and can you show you're working if required. The starter kits are describing screening as a control that must be risk-based, evidence-based, and defensible, and firms need to explain who they screened, what they screened for, and how they dealt with any matches. So why is this happening? Well, Australia is preparing for its FATF 5th round mutual evaluation, with assessors on site the second half of this year. Now they'll be looking at results. They'll be looking at not whether a country has ticked every procedural box, but what is your effectiveness. They want to see that newly regulated entities, gatekeepers, are actually performing CDD, not that they have a process in a document on a shelf. So AUSTRAC built its starter kits with this in mind, particularly when it comes to designated non-financial businesses and professions, the accountants, real estate agents. There has been a very low level of actual compliance around the world. So you've got 80,000 entities coming on stream in mid-26, and for them, screening is going to be a real struggle using traditional commercial solutions. So reporting entities have repeatedly told the Australian government, when this was being consulted on, that the AML-CTF regime needed to be explainable and simple, and it needed to minimise the costs for business. So AUSTRAC's response of telling them exactly how to search using open source tools is a really game-changing novel solution. So what does it mean in practice? Well, the most interesting thing about AUSTRAC's guidance is what it will mean in mid-2026 when these rules come on board, as opposed to what it would have involved if Australia had passed its Tranche 2 laws 1 or 2 decades earlier, as they had promised the international community. So this delay gave them an opportunity to look around the world and come up with what they believe is a unique approach. So an accounting firm's compliance practitioner can have access now to tools that are suited to their business: generative AI, large language models, increasing use of open source search tools. They can cross-reference these results against the publicly available databases like Open Sanctions, for example, which aggregated more than 320 data sources into a searchable database. Open Screening has PEPs, beneficial ownership, and other information from the ICIJ, the Offshore Leaks database. So this is comprehensive. AUSTRAC is now saying that you can run these searches, pull together the results, produce a summary that's formatted for a compliance file, and none of these capabilities necessarily require a commercial subscription or an API key. It's not to say that open source screening is going to replace commercial screening for large banks and financial institutions onboarding thousands of customers every day and monitoring vast troves of transactions. This is really for the lower end of town, small businesses. AUSTRAC specifically says you have to have 15 employees or fewer. But these results for small businesses are in many respects better than the entry-level commercial packages that were available 5 years ago. Technology has transformed this and the cost difference is stark. So what does it mean for Southeast Asia? Well, if AUSTRAC's approach survives Financial Action Task Force scrutiny, other countries across Asia will find this very hard to ignore. Across the region, a commercial screening licence can represent a significant share of a small firm's revenue. So in jurisdictions assessed by the Asia Pacific Group on Money Laundering, the APG, weak controls among gatekeeper professions comes up repeatedly, largely because the small dealers in precious metals, real estate, lawyers in provincial cities, etc., simply cannot adopt the same technology as a major bank, and they are far lower resourced in terms of expertise. So what you get in practice is a split system where you've got large institutions running sophisticated screening and a much bigger informal sector where CD obligations, let's be honest, exist in name, not substance. So an outcomes-based model could break that down. If a bullion dealer in regional Thailand or a real estate agent in the Philippines can show they have screened a customer against public sanctions lists, they've run an adverse media check with generative AI tools, and they've written down what they found and recorded it, the compliance objective of the AML regime has been met. The methods look different from a commercial scan, and it might be more cumbersome and time-consuming, but it is justifiable on a risk-adjusted basis. Certainly that's AUSTRAC's view. So this is explicitly results-oriented, focusing on whether countries are getting outcomes rather than just passing laws and demonstrating technical compliance. Even using basic tools, organisations may score better than a regime with polished regulations but little implementation behind the scenes. And as the FATF moves from technical compliance to effectiveness, this is going to really come to the fore. So there are reasons to think that at least some banks could also experiment with this model, particularly smaller financial institutions, even if only as a parallel channel alongside their existing tools. So compliance analysts already do this informally. When a name screening platform flags a match, the next step is usually run an online search, trawl through the news articles to put the alert in context, pull out false positives, etc. So AI tools are speeding that up, making it more consistent, and meanwhile the cost pressure on compliance is very real. So global AML compliance spending is estimated to hit USD 206 billion a year. Now that is a significant cost that is always being looked at by reporting entities as a way to get equivalent outcomes at a lower cost. There's also the issue of perpetual KYC, which is a trend to consider. The industry is moving towards continuous event-driven monitoring rather than periodic review cycles, and AI tools that can watch information sources, flag changes in a customer's risk profile will fit neatly into that model. Whether the user is a 3-person law firm or a mid-tier bank or a small jeweler, mitigating the risks is critical. Now, open source has clear limitations. We're looking at manual searches might not pick up a designation that was made that morning by a sanctions regulator, for instance. AI tools can hallucinate, they can confuse people with similar names or misattribute adverse media, so there has to be a human in the loop. But the search terms and prompts will have a significant impact, and there is one problem with audit, but if you can manage that audit trail process by doing it internally, this is arguably a really good solution for small businesses. So getting back to Australia, the starter kits require firms to document their screening method, record their search terms and results, escalate anything they can't resolve, and re-screen at intervals that match the customer's risk rating. The bet here is that a well-documented manual process done properly is better than an expensive automated one that nobody actually uses. So what Australia's done here is accept that a one-size-fits-all approach to screening does not work when you're bringing tens of thousands of small businesses into regulation overnight on June 30th. A structured internet search and documented risk assessment might be entirely adequate for a small law firm handling a domestic property settlement, for instance. It'd be wholly inadequate for a major bank, but under a risk-based model, both statements can be true at the same time. So the question that matters here is pretty simple. Did the firm identify the risk? Did it manage and mitigate the risk that it found? And AI tools have made open source screening considerably more capable than even recently. So if Australia's approach holds up under FATF assessment and it gives developing markets across the region a workable template for raising compliance standards without raising the price to small firms, this could be game-changing. The gap between what the law requires and what actually happens on the ground remains one of the biggest weaknesses in the fight against money laundering and serious financial crime. So anything that narrows that gap and leads to better outcomes and lower costs for business really deserves consideration. I'm Nathan Lynch from Regulation Asia. Thanks for joining us.